Hey everyone, and welcome back. We've got some wild swings happening in the financial world right now, and if you're feeling a little confused, you're not alone. The bond market, which is usually a pretty calm place, has been acting like it's on a roller coaster. One day, interest rates on government bonds are climbing, and the next, they're suddenly dipping. It's a real head scratcher, but it all comes down to some recent economic reports that have investors wondering what the heck is going on with prices, and more importantly, what the Federal Reserve is going to do next. Here's the deal. We just got some new numbers on inflation for July, and they're sending mixed signals. The Consumer Price Index, or CPI, which tracks what we all pay for everyday goods and services, came in pretty much as expected, rising just under 3% over the last year. That's a tiny bit less than what the experts thought, and it initially made folks hopeful that the Fed might start cutting interest rates very soon. But then, a day later, we got the Producer Price Index, or PPI, which measures wholesale prices, basically what businesses pay for their stuff. And that number jumped up much more than anyone expected, rising almost 1% in just 1 month. So what gives? This split in the inflation story is causing some serious whiplash. On one hand, the consumer numbers looked pretty calm, but on the other, businesses are clearly feeling the pinch of higher costs. A big part of this has to do with tariffs, those taxes on imported goods our country is imposing. You see, when tariffs kick in, it costs businesses more to bring products into the U.S. Experts are debating whether companies will keep absorbing these costs, which would cut into their profits, or if they'll just pass them directly onto us, the consumers, making our everyday shopping more expensive. Right now, it seems like some of those tariff-related price hikes are starting to show up in what businesses pay, and that's a big deal. Now, let's talk about the Federal Reserve, or the Fed, as we call them. They're the ones who decide whether to raise or lower interest rates, which then impacts everything from mortgage rates to car loans. For a while now, many on Wall Street have been betting big that the Fed would start cutting rates, possibly as soon as September. This idea gained a lot of traction because some recent job reports showed slower hiring and revisions to previous months, making it look like the job market might be cooling down. A softer job market usually gives the Fed a green light to cut rates and try to boost economic growth. In fact, some bond market indicators were showing a very high chance, around 90%, that the Fed would lower rates by 0.25% at their next big meeting. But then that surprising wholesale inflation number popped up, making everyone pause. If prices for businesses are still climbing fast, it might make the Fed think twice about cutting rates too quickly, even if the job market is slowing. They're in a tough spot. Do they focus on keeping prices stable, or do they try to prevent a big economic slowdown? It's a delicate balancing act, and every new piece of economic data just adds another layer to their puzzle. It's also worth noting that there's some political chatter swirling around the Fed. The president has been pretty vocal about wanting lower interest rates, and he's even made some recent appointments to the Fed's board. This has some people wondering if political pressure might influence the Fed's decisions, adding another layer of uncertainty to what's already a complex situation. All eyes are now on their upcoming annual meeting in Jackson Hole, Wyoming, where the Fed chair usually hints at future policy moves. Think of it like a big reveal that could set the tone for the rest of the year. So how are these mixed signals impacting the bond market? Well, we've seen something called the yield curve shifting. Imagine a chart that shows interest rates for different bond lengths, short-term bonds on one end, long-term bonds on the other. Normally, you get paid more for lending your money for a longer time, so the curve slopes upward. But recently, this curve has been inverted, meaning short-term rates were higher than long-term rates. That's usually a warning sign for a recession. But with the talk of potential Fed rate cuts, we've seen the curve steepen again, which means the gap between short-term and long-term rates is widening. This happens when investors expect the Fed to cut short-term rates while long-term rates stay relatively high. And why might long-term rates stay high? A big reason is the massive amount of government debt our country is issuing. When the government needs to borrow a lot of money, it means there are more bonds hitting the market, and to attract buyers, they sometimes need to offer higher interest rates. It's like a supply and demand situation for money. If the government keeps borrowing at record levels, it will keep upward pressure on those longer-term interest rates. For you, as an investor, these bond market movements have real consequences. When interest rates on bonds fall, it generally makes existing bonds more valuable. That's why you might see bond exchange-traded funds, or ETFs, doing well. Lower interest rates also tend to be good news for companies that rely on borrowing to grow, like those in the real estate sector. Think about it. Lower mortgage rates make homes more affordable, which can boost demand. Utilities, too, often benefit because they need to borrow a lot of money for their huge infrastructure projects. And growth-oriented companies, especially in tech and consumer discretionary sectors, can also thrive because cheaper borrowing makes it easier to fund their research, expansion, and acquisitions. On the flip side, banks and other financial institutions can face headwinds. Their main way of making money is the difference between what they charge for loans and what they pay for deposits. When rates drop, that net interest margin can get squeezed, potentially hurting their profits. So it's not a win for everyone. Looking ahead, the next few weeks are crucial. We're still waiting on more key economic data, including retail sales figures, which will tell us how much consumers are spending. And later this month, we'll get the Personal Consumption Expenditures, or PCE report. That's the inflation gauge the Fed pays closest attention to. These numbers, along with any signals from the Jackson Hole meeting, will heavily influence whether the Fed decides to pull the trigger on a rate cut in September, or if they choose to wait. The bottom line is that the market is currently caught in a tug-of-war between signs of a slowing economy and persistent inflation pressures, especially from those tariffs. This means we can expect continued volatility. For investors, it's a time to stay flexible and focus on quality assets. If you're considering fixed income investments, locking in current rates before they potentially drop further could be a smart move. And for stocks, look for companies with strong financials that can weather these uncertain times. It's definitely an interesting time to be watching the markets, and I'll be here to break it all down for you. If you found this helpful, please give this video a big thumbs up, hit that subscribe button, and don't forget to ring the notification bell so you don't miss any of my upcoming videos. Thanks for tuning in, and I'll see you next time.